Retiring before 60 is a goal a lot of us have, but with traditional investing, it can feel out of reach. That's where high-yield investments come into play, like the SPYT ETF. But here's the question. Is this fund a smart path to early financial freedom or just a high-stakes gamble? Stick around as we dig into what makes SPYT unique, the potential income, and why it's something income-focused investors might want to keep an eye on. By the end, you'll be ready to judge if it fits your path to early retirement. Welcome back to High Dividend Explorer, where we dive into high-yield ETFs that might just get you to financial freedom faster. Today, we're exploring the SPYT ETF, Defiance's S&P 500 Enhanced Yield ETF. Now, this ETF claims to offer a juicy yield, one that could either fast-track you to an early retirement or be a risky play. So let's dig in. And hey, if you're excited to learn about high dividend plays that can help you retire early, make sure to hit that like button and subscribe. There's plenty more where this came from. All right, so let's get into what SPYT actually is. SPYT is designed to track the S&P 500, but with a twist. It's focused on high dividend stocks within the index. Think of it as a filtered version of the S&P 500, targeting companies that prioritize consistent dividends. This means you get exposure to major U.S. companies, but with an emphasis on those that generate income. SPYT pays monthly dividends, so if you're looking for consistent cash flow, it's worth considering. Plus, the monthly payout makes it easier to either take income or reinvest to supercharge that compounding effect. Let's take a closer look at how SPYT actually works, because it's a bit different from just buying regular stocks. If you're new to investing, don't worry, we'll keep this simple. SPYT's strategy revolves around two main things: holding shares of ETFs that track the S&P 500 and selling something called daily credit call spreads on the S&P 500 index. Now that probably sounds complex, but here's the breakdown. Step 1. Holding ETFs that track the S&P 500 first. SPYT holds shares in ETFs that follow the S&P 500's performance. The S&P 500 is an index representing the 500 largest companies in the U.S., like Apple, Microsoft, and Amazon. By holding these ETFs, SPYT gains exposure to these big established companies, giving the fund a foundation in the overall stock market's performance. Step 2. Selling daily credit call spreads. Here's where it gets interesting. SPYT doesn't just rely on the growth of these companies for income. It also actively generates income through something called selling credit call spreads. Let's break down what that means. Imagine SPYT has a view on the S&P 500's performance for the day. Each day, it sells call options on the S&P 500 index, which are financial contracts that let others bet on whether the S&P 500 will go up. By selling these contracts, SPYT collects a premium, basically a fee. This is similar to how an insurance company collects premiums. Whether the bet is won or lost, SPYT keeps that premium. To manage risk, SPYT doesn't just sell a call option alone. It pairs it with a second option in a strategy called a spread. This limits potential losses and keeps the approach safer. The daily premium SPYT earns from these spreads is what helps boost its overall yield. Daily repetition for income. The best part? SPYT repeats this strategy daily. By continually earning those premiums every day, SPYT can generate regular income, which is paid out as monthly dividends to shareholders. This income comes from both the performance of the S&P 500 and the premium earned through these call spreads, creating a steady stream of cash flow. Why use this strategy? The goal here is to get consistent, high-yield returns. With SPYT targeting around a 20% yield, it's an attractive option for investors who want income regularly, whether to spend or reinvest. So to put it simply, SPYT combines traditional growth from the S&P 500 with a more active income-generating strategy from selling credit call spreads. The end result is a high-yield ETF that can generate monthly income while also giving you exposure to the broader U.S. market. Now let's talk pros and cons, because high-yield ETFs like SPYT aren't all sunshine and rainbows. Starting with the pros, SPYT provides a higher than average yield compared to a classic S&P 500 index fund. This ETF aims for an impressive 20% yield, a number that can be game-changing for monthly income or reinvestment purposes. And with a yield that high, you don't need as large a portfolio to generate substantial income. It can be a fantastic choice for those who want that monthly income but might not have a seven-figure portfolio. Pros: high yield. Better cash flow for those needing immediate income or aiming to reinvest for compounding. Monthly payouts: regular income that can either be reinvested or taken as cash. Potential for growth: exposure to large cap companies. But on the flip side, there's always a trade-off. High-yield stocks can be risky because they're often more sensitive to market conditions, especially during economic downturns. And with SPYT, because of its focused strategy, you could end up more exposed to certain sectors or stocks than in a typical diversified index. Cons: sector risk. More concentrated risk if certain sectors or companies struggle. Yield versus stability. Higher yield can mean higher volatility, not everyone's cup of tea. Market sensitivity can be more reactive in market downturns. So how can you use SPYT to your advantage? One approach is to DRIP, or Dividend Reinvestment Plan. By reinvesting those monthly dividends, you can increase your share count and compound your returns over time. Alternatively, you can use the monthly payouts as income, helping to supplement other revenue streams without needing to touch the principal. Now let's compare SPYT to a well-known classic, the Vanguard S&P 500 ETF, or VOO. I'll show you how both of these ETFs would have performed with an initial $10,000 investment over a recent period, from March to November 2024. We'll look at two scenarios, one with dividends reinvested and one without. Let's dive into the numbers. First, let's talk about growth when dividends are reinvested. Reinvesting dividends can accelerate your portfolio's growth over time by letting you buy more shares, which then also earn dividends. Here's how SPYT and VOO stack up. Starting with $10,000 invested in March 2024, you'd have about $11,487 if invested in SPYT, $11,684 if invested in VOO. In terms of growth, that's a total return of 14.87% for SPYT and 16.84% for VOO. 16.84% for VOO. The annualized gains? SPYT gave 22.15%, while VOO gave 25.09%. Even though VOO slightly outperformed in this period, SPYT still delivered solid returns. And it's worth noting the monthly dividends from SPYT may be more attractive for income-focused investors. Now, if you prefer to take your dividends as cash rather than reinvest them, here's how your investment would have grown over the same period. Starting again with $10,000, your ending investment would be about $11,364 with SPYT, $11,674 with VOO. In this case, SPYT had a total return of 13.64%, and VOO had a total return of 16.74%. The annualized gains came out to 20.33% for SPYT and 24.94% for VOO. So while VOO shows slightly higher growth overall, SPYT offers a high yield that can make it ideal for monthly income. You might not get as big a bump in share price, but SPYT's income can help support other goals, like early retirement or creating a steady cash flow. For income-seeking investors, SPYT is a solid option because it balances yield with exposure to some large, recognizable companies. You don't need a massive portfolio, like you would with a lower yield fund, to create meaningful income. But just remember, with higher yields come higher risks. So make sure you're comfortable with that and consult with a financial advisor to tailor your investments to your specific goals. Remember, investing is personal. There's no one-size-fits-all approach. If you're looking for a combination of growth potential and monthly income, SPYT might just be a good fit. But always do your research and talk to a professional to ensure it fits your goals. Before you go, don't forget to hit that subscribe button. We've got tons of great content on high dividend ETFs and how to accelerate your path to financial freedom. Stay informed, stay invested, and keep exploring those dividends.